So I'm going to kind of get going into today's agenda and try to keep this under an hour, and then we will be available all night long if you want questions, but usually we're not that captivating. So we'll start for today. We're going to talk a little bit just about ourselves, the presenter, so you have a little bit of awareness of who we are. I do see some familiar names. Touch on the current environment, what's going on in the markets lightly, and kind of how that segues into real estate in the portfolio. We'll touch on items such as interest rates, kind of what's new for 2023, the financing, ABCs, and popular mortgage topics. It isn't a traditional investment type of presentation we've done. It is going to be very heavy towards the mortgage side, just because of the changing interest rate environment, the impact it's had on real estate, and just kind of some discussions that it's had on there. So I'll kind of start off a little bit on us. Steele Group, for individuals that are not familiar, is based out of Cambridge, Ontario. We do cover most provinces in Canada from a group and benefits standpoint through a division that we call Regroup, and manage over $300 million for individual wealth clients. Myself, Cliff, and Mark are partners in the practice and predominantly focus on wealth and planning, and we have an expert on insurance next to me, Neil, which focuses on estate planning, complex insurance structures. And comically enough, we started at the same time in the industry, so it makes it very easy for me to do a quick bio page. And the easiest way to look at us is I focus on wealth, Neil focuses on insurance, and the core designation is the CFP, which is Certified Financial Planner, to kind of cover off our basis. Now, to touch on Penny real quickly, I'll let her talk a little bit about her hometown financial.
Great. So thanks for having me. I am part of the Mortgage Centre Hometown Financial. That is our franchise. We were originally founded in 2011. Currently, we are funding $250 million in mortgage volume annually as a franchise. We have just over 25 team members and staff currently. And currently in Ontario, we have 11 franchise offices in Central and South Ontario.
Awesome.
A little bit about myself. I got into the industry originally in the year 2000 and became a franchise owner in 2011, and serve all of Ontario and have access to all the other provinces as well as US programs as well.
All right, so I'll start off a little bit on the planning side. For individuals who've dealt with us, they know we have a very financial planning first focus. It's a very simple process that has a lot of complexities in it, but in short, it's always just getting a good foundation of the objective and kind of analyzing how it fits into your plan. And throughout this presentation, we're going to touch on real estate, and there's different aspects how it can fit into a financial plan, investment allocations, portfolios, and like any other major life event, buying a home is one of the biggest decisions individuals tend to do, whether it's a rental or it's your primary residence or you're downsizing. Now, the big event throughout last year was the story of inflation, and the primary way to beat inflation is to raise interest rates. Basically, governments, and it mainly did start with the US governments, are aggressively hiking rates. And as you can see on the chart on the right-hand side, the bottom line is inflation, and the top line is the S&P 500. And whether you look at the 60s, the 70s, the 80s, and as recent as this past year, as long as inflation persists, the government will persist in raising rates, and the markets will continue to price in a recession or a correction until they have some kind of confidence that we're at the end of that cycle. Once inflation is broken and starts to come down, you tend to see a lot of alleviation in the markets, some good pickup. And I will note that this chart's a little misleading, as at the end of the day, it's compressing many decades into one table. It isn't as if there's a change that happens overnight and all of a sudden the markets jump up. It can take obviously a few months or a year sometimes. But we have seen that event recently with inflation coming down. Basically, it has been due to increasing rates, and you're finally seeing some job losses throughout the various industries that start happening in the fall. And as we kind of entered into September, October, November, you really kind of saw a bit more stabilization. And that pretty much has led off to kind of the markets rising a bit. It's also created a situation where you see a bit of inversion. Typically, if you have a GIC, something that's guaranteed from a bank, it's interest rate sensitive. If I went to a bank today and I gave them $100,000, they will lock in my money and promise to pay me an interest rate. Normally speaking, the longer I lose access to my money, the longer I lock in my money for a 1 year or 2 year or 3 year, the more they have to pay me for that privilege in a sense. But it's completely inverted at this stage. Banks are pricing in interest rate cuts. If I walk into TD, RBC, or any of the various GIC institutions we can buy from, what we notice is the 5-year GIC is far lower than the 1-year GIC. They're basically refusing to guarantee money at these higher rates over a longer period of time. They're more than happy to do it for 1 year, but the inclination of where we are in the cycle for inflation, what we're seeing is that we're likely over that hump and starting to head down, meaning that maybe in 12, 24, 36 months, you're going to see some movement there on that side. Now, real estate and your own investment portfolio, I like to just reference a Canada pension plan because it is the biggest investment we all have. We all pay into the CPP, or most of us do, and it holds a tremendous amount of assets, and they allocate about 11% of their assets to real estate. And then there's some other components like infrastructure and so on that are real estate sensitive at times. And so you have to kind of look at your own situation. If you're an individual that doesn't own any real estate and you have investments, you can be widely diversified, see a lot of growth. But for many individuals, when they do buy a property, it does become their biggest asset. It can very quickly, if you have $1 million property and $100,000 investment portfolio, real estate is basically your biggest investment you have. And then you can always go further if people do play with commercial rental properties or individual rental properties. It can act in that side, but just like anything else, diversification is key. Now the pros, it could generate income if you decide to rent out your basement or you get a rental property. Over a long period of time, we've seen appreciation in real estate. I think we've had an abnormal cycle in Canada of tremendous growth. In most real estate markets globally, it tends to go up and down like the markets do. But Canada has had a huge benefit on that side. But as we've seen recently, it can also go down. And anyone that bought a short-term rental and they were into this flipping rental properties every single year are probably having a tremendously horrible year, where if they bought a new build last year, it's finally getting completed, it is causing them some issues. And then they find out if they need to sell, it's not very liquid unless you really lower your price. And that's really what will make something liquid, is just the demand for the price. And then another important factor is a very large percentage of Canadians are retiring with a mortgage. And so more and more, when myself, Mark, and Cliff sit down and do a financial plan for an individual, we are basically having situations where we're looking at the idea of downsizing in retirement, or there's very creative ways where if you had a larger mortgage that you've been paying down throughout your lifetime and you still have a bit sitting there, from a balance standpoint, you can re-amortize with a mortgage broker and kind of lower the overall expenses from a sense, because it's to free up cash flow. And there's different creative ways we can plan on that side. Next up, we're going to talk a little bit about kind of the impacts of real estate on an estate standpoint. I'll segue to Neil. Basically, a lot of times when we're doing estate settlements or estate planning, people do ask about taxation. You know, your principal residence is tax-free if you sell it. It is subject to probate. But where it gets a little bit more complicated is as soon as you have investment properties where there's capital gains on it, or more commonly like a cottage or a family property that's shared and you want to pass it down to your loved ones, that tax event can result in a very large bill for the estate. And the biggest solution is selling the property. But in some cases, someone might want to retain the property. And there's ways of setting up an insurance policy and protecting that side of your estate. But I'll pass over to Neil and touch a little bit on the protection side.
Thank you, Mario. Hello, folks. Saw a few names that I recognize join us here, so lovely to have everybody. I just want to touch briefly on risk management, because when you're talking about real estate, we want you to be able to keep that real estate. Should the worst happen to you, namely dying, you want it to pass to the people you care about without having to incur any debt. But there's other stuff that can happen too with respect to illness and disability. So I thought I'd quickly touch on that before I pass it to Penny to touch on the mortgage side of things. So the three big risks that you want to consider in anything in life, but to just, particularly pertaining to what might happen to your real estate, is something happening to you in terms of death, illness, or losing your income. And there are three product lines, broadly speaking, that we use to protect those things. Some of you may have had this discussion with me in the past: life, critical illness, and disability coverage. So life insurance, everybody knows how that works. If you die, money pays to a named beneficiary, bypasses probate, completely tax-free, and there are term and permanent coverages available. Critical illness is kind of like life insurance, but you don't have to die, which is a fantastic feature. If you did have cancer, heart attack, stroke, some severe illness, then a lump sum gets paid to you tax-free to use for whatever you want. Primarily, people use these funds for treatment, either more quickly than OHIP might be able to provide, going private with that, or for treatments that may not be covered by OHIP. And lastly is disability. This one doesn't get touched on as much because it's very complicated as a product line, but arguably it's the most important one. And this has to do with insurance for your paycheck. If you lose your paycheck, your entire financial plan goes down in flames in many cases. And so you want to make sure that you're protecting that. When people think disability, they think falling off a ladder or ending up in a wheelchair, but really this has anything and everything to do with your ability to do your job. So in terms of implementation, many of you familiar with our 3-bucket approach to financial planning, and insurance is no different. If you were to imagine how you might allocate a budget of, say, $200, just for the sake of argument, across the different product lines, typically your disability insurance is going to make up the majority of that for a number of reasons, but not the least of which is it's the most likely bad thing to happen. So it tends to be the most expensive to cover. And then life and critical illness tend to make up a similar sort of roughly 50 to 60% between the two of them to balance out the rest of that insurance portfolio. The process we go through, many of you have been through with me doing this before. First, we analyze your needs. We make some recommendations based on those needs. We apply for anything that we determine you want to move forward with. You underwrite, so we make sure that the insurance company is willing to provide insurance at the rate we've quoted, and then we finish with the delivery of the product that you've purchased. This is just an example here pertaining specifically to a mortgage. So if you were just looking to insure your mortgage, you can see in these 3 different scenarios of death, severe illness, and loss of income that if you only have life insurance, which is what most people tend to do when they get a mortgage, you're not covered for a whole lot of other stuff. And so whenever you're looking at taking on new debt, it's usually a time when people review their insurance portfolio. So make sure, just like you do with an insurance or with an investment portfolio, you're well diversified across those various risks. Here's an example of what those costs might look like, because everybody naturally is interested in the bottom line. And for those numbers I showed on the previous screen, so the $500,000 mortgage, $2,000 worth of monthly payments, this slide was made before the recent rate hike. So some of you may be looking at me like, yeah, right, $2,000 on a $500,000 mortgage, that would have been nice. Property taxes at $500 a month. These are the kind of numbers that you would be looking at, say for a 35-year-old couple looking for this. So, you can see on the far right-hand side, you're paying less than it costs to insure 2 cars. To ensure arguably the most important asset you're going to have in your life. Group benefits is something that comes up. Group benefits are fantastic. I really have been encouraging, and all of us actually, the advisors at the office, have been encouraging our clients to review their group benefits. I offer opportunities to review those with our clients as well, just to look through what you have, because you often don't have what you think you do. And if you do have what you think, then that's great. But we want to make sure that we're complementing those group benefits with appropriate individual coverage wherever necessary. And you can see in these different examples how things shake out with no group, some group, and individual coverage added to your group coverage. A little bit on mortgage protection. So oftentimes when you apply for a mortgage, that mortgage professional is obligated to offer mortgage insurance. Many of you are probably aware of the virtues of individual coverage as opposed to the lender's mortgage protection. One thing I will say in favor of mortgage insurance, and actually Penny and I believe, talked about a situation related to this recently where in the middle of a deal closing, the individual closing that deal actually passed away. And it creates all kinds of chaos in that particular situation. So with mortgage insurance, when you buy that, when you sign on the dotted line, you are covered from that moment. So if any of you out there still have mortgage insurance because you ticked the box, because you wanted to have a look at it, it's great to have initially. But after that, make sure you're getting in touch with us to look at an individual solution, because it's often more affordable and has all kinds of different benefits, which you can see on the screen here. We get into as well talking about term insurance. This is something that comes up very frequently, and looking at different options for short, medium, and longer term needs, right? So these are the 3 most common term lengths for your life insurance. In this example, it's a 35-year-old male non-smoker. In the first 10 years of that $1 million of coverage, if you look on the left-hand side, the 10-year term is $38. But if he keeps that term over time, you see the premiums just go up and up and up. And if he keeps that same policy, renewing every 10 years, you've spent over $9 grand on that $1 million of coverage. With a 20-year term, you've only spent $7,200, and a 30-year term covers you for the whole period At $108.45 a month, you've only spent $3,200. So on the surface, this looks like you should just buy the 30-year term, lock it in. That's kind of mortgage language, right? But is that realistic? The reality is that when it comes to life insurance, two things are true. One, people are living longer, and so that's putting downward pressure on life insurance pricing. So if you haven't looked at your insurance portfolio in a while, make sure you reach out, because there's a good chance that we're going to be able to find a solution that's as good or better than what you have right now. Even though you're a little older, there are some cases where I've actually found it a little more affordable, despite being a little bit older. And the other thing is that your liabilities, your need for life insurance inherently reduces over time. And you're usually in your 30s, give or take, you're going to have the highest need for insurance you're ever going to have, taking on kids and a mortgage and all kinds of obligations. As time goes on, those needs reduce, and so too does your need for insurance. So what we tend to do here is kind of leapfrogging your coverage. Instead of sticking with the same policy over time, much like we do with your investment portfolio, we want to review and reassess your coverage. So in the same 35-year-old male example here, comparing a 10-year term to a 20-year term, from age 35 to 43, this individual needs $1 million. And by then he's been very responsible, paid down his mortgage, kids are a little older, and his need goes to $500. And because of this downward pressure, if I imagined I price a 44-year-old today at $500,000, it's about the same cost as $1 million when he was 35. So we're keeping that monthly spend in check. And if we continue that trend, by the time he's 51, he only needs $250,000 to get him to pretty close to retirement. So the cumulative total spend for almost all the years you're ever going to need life insurance is just under $13,000. If you had gone with a 20-year term and done what most people do, which is ignore it for a long period of time, you can see just how much money that not dealing with it costs you. It's not always the most fun thing. I'll be the first to admit that a lot of people find it arduous to look at their insurance portfolio more often than they absolutely have to. But I really show you here the power of looking at it, even just every 4 to 6 years. There's substantial savings to be accumulated there in doing so. There are drawbacks to going with shorter terms, not the least of which is that you have to qualify medically every single time you do that. So, but I would say if you look on your screen here, you'll see most of the cases that I do are approved either standard or on a slightly rated basis. And maybe the odd 1 in 10 ends up being declined. So odds are very good for the most part that you will be insurable. And if you're not, there are generally options we have to kind of get around that. So nothing wrong with taking a longer term. If paying that extra money gives you peace of mind, then that's money well spent. But we're always looking for ways to save you money on your insurance rather than trying to give you the biggest policy possible at every turn. So I'll pass everything over to Penny to continue on with mortgage and financing options.
And as I quickly segue, I'm going to have a quick question.
Oh, what is the purpose of life insurance when you are retired and no mortgage and collecting from your RSP? Well, I'll give you the sort of cop-out answer, which is it depends. So really, if you're retired and you don't have obligations in terms of debts or a need to replace income, then you probably don't need life insurance for a traditional reason. At that point, really what all you would want it for is maybe a small permanent policy to cover off funeral expenses. When death takes place, oftentimes a little bit of extra cash flow into the house can help pay for funeral and legal costs. It's very, very helpful. I'm sure many of you have been through that situation where a little extra cash would have helped pay for some of those things. The other situation is in estate planning. Sometimes you'll be dealing with things like estate equalization, where say most of the estate value is wrapped up in the home, and the home, one of the kids, and let's say you have 2 of them, loves the family home. You want to be able to pass it to them, but so much of the estate value is in that home, you're not being fair to the other child. So oftentimes we use life insurance for that. And the third and most common reason to use life insurance in retirement is for tax planning. It turns out that the 2 things that are guaranteed in life and taxes, one of them incurs the other. So when you pass away, if you have 2 spouses, there's a spousal rollover from the first spouse deceased to the surviving individual. Usually there's minimal taxation that's incurred in doing that. But on second death, there's what's called a deemed disposition of the assets. So imagine you take everything you have, and you sell it today, that's going to cost a whole lot of taxes. And so we often use permanent life insurance products where appropriate. We don't just recommend them for no reason. Sometimes they can help shore up lost money going to the government to help keep the estate intact. So I hope I answered your question on that.
Perfect. And we did get another question on kind of risk management, but more to do with title insurance. We'll touch on it in a little bit. I'll kind of let Penny go into her part on the mortgage side and kind of touching it to that or at the end. But yeah, love the questions. Feel free to keep bringing them back. But without further ado, we did bring a great guest to our office. We're happy to have her here. And I'll let you take it away.
Awesome. Thank you. Perfect. Okay, so interest rates. This is a hot topic for sure. I get asked about this all the time. So latest rate forecasts. So on the next slide, which we're going to look at in a moment, the big six banks were expecting last month, we're expecting a 25 basis point hike, which did happen. So right now, the big six banks are actually expecting to see towards year end, they're actually expecting to see the overnight lending rate come down a little bit. So, and the overnight lending rate is directly connected to prime rate. So right now, prime rate is pretty high. So we're sitting at 6.7 right now for prime rate, which is what's directly affecting anyone with a variable rate mortgage and anyone that has lines of credit right now as well, okay, from a borrowing perspective. So that is something that I frequently get asked a lot about. And right now, that is definitely what what I've been getting asked a lot about is just specifically prime rate and if it's going to be coming down. So this year we are going to be looking at it coming down a little bit. I actually read an article earlier this week that we're probably actually going to be seeing prime rate come down possibly earlier this year. So there was two articles that came out, Financial Post this week, and I think there was one other article. But there was some talk about prime rate actually coming down a little earlier this year. So that is some good news for anyone that has a variable rate mortgage. I want to hop to the next slide. Okay. So this slide here was provided by CREA, Canadian Real Estate Association. So this is just average house price in Canada. So this isn't specific to any one city in Canada. This is the entire country. So last year we saw house prices peak, and then we saw them come down significantly last summer, but they seem to have stabilized. So that was something I kind of wanted to point out on this slide. It does look like, I mean, from July to December, we do see some stabilizing in house prices, which is definitely some good news. Because, you know, we've been hearing, you know, have the house prices bottomed out? Are we going to see a crash? So on. So that's a question that frequently comes across my desk as well. And, you know, looking at this chart, that's very indicative that we seem to have seen some leveling off in house prices, which is some good news. Okay, next slide. Perfect. This is the 5-year high ratio fixed rates. And we've been seeing those drop as well. So we saw a peak back in October. So a 5-year fixed rate was going at 5.44. Back in December, we were seeing 4.89. It's actually come down a little bit more since. So right now we're seeing 5-year high ratio money. I'll explain what high ratio money is in a moment. But right now we're seeing 5-year high ratio money at about 4.69. So that is also good news. So we're continuing to see rates drop with mortgage money right now. For anyone wondering what high ratio money is, that is anyone that is looking at buying a home and putting less than 20% down. So if you're purchasing a house, putting 5, 10, 15% down, those are the type of interest rates that you'd be looking at getting today. So 4.69, somewhere in around there. And that's for 5-year money, okay? I threw in another slide here. This is Toronto Real Estate Board. So again, just looking at house prices as well. So we saw the peak. So the green is indicating the peak of house prices last February. And then we saw some bottoming out again last summer, and a little bit in December as well. So, and based on the type of property itself. So detached, semi-detached, townhomes and condos. But we did see with detached and semi-detached, we have seen a little bit of price increases happening again. So again, leveling out in the housing market. So that is a little bit of good news as well. So it looks like we may have seen sort of the bottom of the trough, so to speak, in terms of price drops. Perfect. Some things that are new for 2023. This one here, the first home savings account. So this is one that we've talked about with Mario and with Neil as well. And they may have some input on this as well. The first home savings account is new this year. So this product is really interesting. This is if you are looking at saving for your first home. You can save up to $8,000 per year, up to $40,000 in total, tax-free towards your first home. There's no payback required. This is really interesting because what happens is you can put up to $8,000 per year into this, and it is tax deductible, very similar to an RRSP. However, when you do withdraw this money, you don't have to pay it back like you do with the original home buyers plan, if anyone's familiar with that. So this is something that's really interesting and new for this year. So do you boys want to add something to this as well?
Yeah, I can throw a few other bits. This is a brand new account. We did get a question in the chat that is this just not another TFSA? So the biggest difference between this and a TFSA, it is its own entity, its own account, investment account type. So think of an RSP, think of a TFSA. Again, another bunch of documents that you'd have to sign to open it up. But it's taking two components. The money that goes in actually counts as an RSP contribution. So that's the difference between a TFSA and this account. It does not really eat up your RSP room. This was a rushed program that Trudeau announced at the end of last year, and he had to make quite a bit of amendments last minute also before it went live. So as of a week ago, the CRA website was quickly still adding updates and even had some grammatical errors. I think they're not used to trying to invent an account that quickly. So the one warning I do have is when TFSAs first did come out, there were a few impressions that were made that the CRA then came back and made some changes. So just the way I'm viewing these is it's something that you use in the calendar year. It's not like an RSP where you have the first 60 days of the year where you can do a contribution today and it counts for 2022. It is based like a TFSA where it's calendar year. So if you put money into this account today, it would only apply for your 2023 tax year. There is no commentary on time frame. The way CRA has worded it is that you can technically throw $8,000 in today, and in a few weeks take it out and use it towards your first time home purchase. And so that's where there is some interesting opportunity for some individuals that have not yet bought a house. They already have assets they're about to spend to buy that house. They can quickly throw $8,000 into this account, rip it out in a few weeks, and next year when they do their taxes, get a little bit of extra money. If you don't use up these assets, you can roll them into an RSP. At that point, it does use your RSP room. And we have an article on our website with more details on it there. Yeah.
Perfect. Excellent. And so this is used for your first home. So it is meant for your principal residence. So it's not intended to be used for anyone that's looking at buying a first property that's a rental property. So that's something to be clear of as well. So they're very specific with that, with the intention of the used funds. Oh, and another thing, if you end up not using these funds to buy a home, you can transfer these funds to your RSP.
Yep.
So that's something as well. That's great.
And one more question. Well, so if I maximize this contribution, I use it. Yeah, that's exactly it. So yeah, it's the question was, what happens if I maximize this contribution, don't use it, will I be taxed? If you withdraw it, yes, you'll be taxed on it as if it was money out of an RSP, which is unfortunate. But like Penny said, you can roll it into your existing RSP.
Yeah.
It, interestingly enough, has a rule of similar to an RSP where you have up till age 71. So you have a lot of time if you decide not to buy a home today and you're saving up. The other component is you can use missed contributions kind of like a TFSA, but only 2 years at a time.
Mhm.
So you can do $8,000 in a single year. If you don't use it this year, next year you could do $16,000. If you, let's say you don't use it for 3 years, you can only do $16,000 on any calendar year. So there's a couple of odd rules that you want to double check, obviously, if you did go down this path.
Great. So next topic is the anti-flipping tax, as we're calling it. So it's not a formal name, but it is frequently called this in the news. It's specifically an amendment to the principal residence exemption. So a couple of years ago, the principal residence exemption was introduced into tax laws for anyone that was selling their principal residence. When they were filing their income taxes, they had to claim that, and then they were exempt from any taxes that they would have to pay on their home. So there was no capital gains on their principal residence. However, this year, there is a modification to that, and it's specifically to do with if you are selling your principal residence in less than a 12-month period, they're basically now considering it a flip, that you're flipping your home, and basically looking at it as though you are buying and selling your house in less than 12 months because you're intending to flip your home and use it for profit. So there are some exemptions or exceptions that apply. Things such as death, for example, or if you are moving because you have accepted a job somewhere and you're required to move for that job, or the breakdown of a relationship as well. So if you can prove these types of things, then of course the exception applies. But otherwise, the anti-flipping tax would apply, and you will be subject to additional taxes for selling your home. So that is new this year. The foreign buyer ban. So this has been something that's widely been announced in the news as well. There is a 2-year ban that's been issued that no foreign buyers may buy real estate in census metropolitan areas and other CA areas of Canada. So I believe I have another slide in here, which we'll touch on in a moment. And the Toronto vacant home tax. So anyone that has properties in Toronto, all Toronto homeowners are required to declare the status. I have a typo in there, are required to declare the status of all owned properties. Vacant properties are now subject to a 1% annual tax on current assessed value of the property. So if you have a house that is worth $1 million and it's sitting vacant, there's a $10,000 annual tax that you need to pay on that. There was an extension, I believe, to the end of this month, I believe, because about 15% of Toronto homeowners have yet to declare the status of their property. So City of Toronto is still waiting for about 15% of property owners to make their declaration. So I'm sure they're going to be out hunting people down soon.
Yeah, you give a good opportunity to collect some tax revenue. And
That's right.
So you get excited with that.
That's right. Right. Oh, so this was the first home savings account. So we actually had just a few more details on that. So again, $8,000 annually, up to $40,000 maximum allowed. Contributions are tax deductible, just like an RSP. Withdrawals are similar to a TFSA, as they're not tax deductible when buying a home. And you can transfer it to an RSP if you do not buy a home. And you must buy a qualifying principal residence. No payback is required into the first home savings account fund, which is unique. Foreign buyer ban. So that one I touched on in the last slide, but I wanted to just touch on who can still buy a home, because there are a lot of exemptions to this. If you have a temporary work permit, you can still potentially buy a home here. Certain international students can also buy a home. Refugees can also buy a home. Permanent residents, people with PR status, can also buy a home. And non-Canadians that are living with a Canadian spouse or common law partner can also buy a home. And also homes that are outside of the CMA or CA areas, so that's areas that have 10,000 population or less, are not included in this. So rural areas, places that have like cottages and small little lake town areas and things like that, foreign buyers can still buy homes in those areas. And also multi-unit properties and apartment buildings, industrial complexes, anything commercial can also still buy as well.
So a question was on landed immigrants. Where do they fall in this category?
Oh, that's interesting. So landed immigrant, if they have a temporary work permit as a landed immigrant, then they would fall under that category and could still buy. If they have their PR status as a landed immigrant, they could buy. If they don't yet have the PR status, then they actually would not qualify unless perhaps they're living with a Canadian spouse or common law partner. But the traditional landed immigrant, I believe, is not included in this currently. So that was part of the rules with this program right now. They have to fall under some of these very specific categories. So they have to either have work permits or student visas or permanent resident status. So there has to be very specific visas that the immigration status is currently sitting in. So it's very specific about that.
There'll still be probably a lot of different ways people try to get creative with it. Canada has a huge demand for workforces, and so
absolutely
getting a work permit might not be that difficult, but it does create at least a few steps needed extra to buy a property versus someone overseas coming in and loading up on real estate and not even coming to Canada or just popping in quickly. There is also one other one.
Is just the designation of the property itself, right? Like if the property is a multi-unit, things like that, right? So anything above 4 units. So it's 5 units or more, then that's allowed. So even in a major city, right?
Yeah. So you have to think of an investment firm. So let's say a group of individuals got together and they're buying a 15 units as an investment corporation in Canada. That is a business, and businesses are not really subject to this.
Fine. Yeah, it's perfectly fine. So it's very specific to residential properties in major cities that if they don't fall under these specific categories. So yeah, and it's a 2-year ban at this point. So a world of lending options are available. So A, B, and C lending options. So in the broker and banking world, we often refer to lending as, A lending and B lending, and then private lending or sometimes C lending. So I like to call it the ABC of lending. So A lending is typically prime lending. Prime lending is bank lending or something very similar to a bank, such as a trust company or a credit union. That is typically what we consider to be prime lending. Alternative lending is sometimes a division of, for example, a credit union or a trust company as well. So a lot of smaller institutions such as credit unions have alternative divisions. And then we have private lending as well. So private lending is something entirely different. We have, in Canada, we have mortgage investment corporations. Some are publicly held, some are privately held. And then we have literally private lenders, which are just people that have lots of money and they are willing to lend it out. And so that is typically your A, B, and C type of lending. So that's it in a nutshell. So prime lending. So again, what it's all about is down payment. With prime lending, you can buy a house with as little as 5% down. Typically, your credit score needs to be 620 or higher. Income, you need to be able to prove your income with pay stubs and tax returns. And prime lending offers insurable mortgages as well. So this is where if you're buying a house with less than 20% down, you can insure the mortgage through CMHC or one of the other mortgage insurers in Canada. Alternative lending. So alternative lending, a little bit different. You do have to have 20% or more down. Typically, bruised credit is okay. People that use alternative lending do not always have bruised credit. There's sometimes different reasons why people will use alternative lending. Fees do apply in alternative lending. So typically it's not uncommon to see a lending fee of 1%, sometimes higher, but on average, 1% is very common to see. And unique income sources are allowed. So in alternative lending, a lot of the time, what we've been seeing, and we've been seeing more and more of this, alternative lending right now is becoming very popular because interest rates are very high right now. And so we're seeing a lot of clients, even clients with excellent credit, like absolutely wonderful, excellent credit, are being declined by their banks, and their bank is declining them because they don't qualify based on their income. And their income is great. But what's happening is the interest rates are so high at the bank, and the rates that we have to qualify a client for at a bank interest rate, they just don't qualify. And so when we go over to the alternative lending side, the rules are a little bit different. And alternative lending allows us to have a little more flexible rules. And so we can allow more flexible, what's called debt ratios, meaning that a client can have a wider allowance of debt, essentially. And so this is where the alternative lending comes in. And it's interesting because often we've always thought that alternative lending must be sky high interest rates. But fascinatingly enough, alternative lending right now, the interest rates are almost the same as what we're seeing at the banks. So for example, Scotiabank's 1-year mortgage rate right now is 6.29. It is a little high, but that's what it is. It's a 6.29 for a 1-year fixed mortgage at Scotiabank. And alternative lending is also 6.29 for a 1 year. The only difference is there is a 1% fee on the alternative side, but it's actually the exact same interest rate for the exact same term, but it's a more flexible rule. And what it's doing is it's allowing the person that is borrowing money to do exactly what they want to do. So even though their bank said no, we're still able to get somebody the money that they need for whatever it is that they're doing, whether they're buying an additional property or they're refinancing or they're, buying, something else. Whatever it is that they're doing, we're allowing them to accomplish that goal, and it's not really costing them much more money. So at the end of the day, it's a great option. Private lending, entirely different, really. 20% down payment or more is required. In most cases, and then income and credit, not always a big consideration in private lending, and then additional fees apply as well. Private lending is really interesting because we will often see scenarios where, for example, I'm working with some clients right now. They have a portfolio of properties. They have 40 properties right now, and they're buying another one. And so what we're doing is a portfolio loan for them. So because they don't want to put any money down on the next property that they're buying, we're actually lending them the money to acquire the property that they're buying. Plus we're giving them money to renovate the property because they're going to be renovating it. Because they have such a large portfolio of properties, we're actually going to give them the money for the property they're buying, plus give them the renovation money by putting a mortgage on the property they're buying, plus register a mortgage against a couple of the other properties that they own in order to securitize and reduce the overall risk by securing on multiple properties so that the private lender that's giving them that money is better securitized. But what it's doing for the borrowers is it's allowing them to buy a property and literally put nothing down. And so it's a short-term plan for them. They're planning to borrow the money for about 4 months. They're going to renovate the property, get it into ship shape, and then we're going to refinance that property with another institution and pay off that loan, free up the security against the other properties, and they'll have just a regular mortgage against that property at the end of the day. So it's a great option for them, and that's something we couldn't do in other types of lending. Popular mortgage topics. Accessing the equity in your home. So people often want to access equity in their home. Our homes are often the biggest assets that we have. And so people want to access the equity in their home. They'll use it for things like home improvement or paying for school tuition for kids going to college and university, buying additional properties, investing, retirement in some cases. How do you access the equity in your home? There's multiple ways to do it. Most commonly, people will refinance their home. So you can do things like take out a whole new mortgage on your home, or you can add on to your existing mortgage that you already have with your institution, just simply by adding some additional money and re-registering the mortgage against your home. You can add a separate line of credit or a HELOC, so home equity line of credit to your home to access the equity in your home. Or you can add an entirely new mortgage. So sometimes adding a whole new component. So you can add, this is something that's becoming really popular right now, is adding a whole new mortgage component. And that's because a lot of people right now have a really good rate on their existing first mortgage. If you have, you know, a 2% mortgage right now, and it's not renewing for another 3, maybe 4 years, you really don't want to be touching that mortgage right now. And some mortgages, it really depends on whether you can blend your rate and add new money to it or not. Some institutions will allow you to do that and some won't. It really depends on the mortgage itself. If you don't have the option to do that, this is where adding an additional mortgage component can come in handy. So you can either add the new mortgage component or the HELOC, but adding that additional mortgage component can really come in handy because you don't want to lose that really great rate that you've got on your existing first mortgage. Fixed and variable, what's right in today's market? This is always a hot topic. So total mortgages outstanding in Canada right now, $1.68 trillion right now. Average outstanding size of a mortgage is just over $240,000. And the percentage of all Canadian mortgages that are currently variable rate mortgages is 13%. So not a lot. However, the trend that we've been seeing is that of all new mortgage borrowers over the last year, just over 44% of them took a variable rate mortgage. So it's kind of an interesting trend that we've been seeing. And Jen, just a quick mortgage comparison. So on a $500,000 mortgage, based on the current interest rates, what would the mortgage balance look at in year 1, year 2, and year 3? So just giving you a quick little snapshot. So the reason I highlighted this was just to give you a little bit of an idea. I didn't post the payment on there. I guess I could have, but I didn't post the payment on there. But what I really wanted to show you was how the mortgage balance comes down. Even with the higher interest rate, your mortgage balance really isn't shockingly different, even with higher interest rates. So like the 5-year fixed and the 3-year fixed, there's, you know, a significant rate difference there. But in year 1, 2, 3, like the balance itself is coming down pretty much on par. And then line of credit as a tool. So lines of credit, or HELOCs, as we know, are an excellent tool. Several different reasons for this. You can, number one, protect the title of your home. And this is something that I think we were talking about a little earlier today. So having a HELOC registered against your home is actually going to protect the title of your home. So when people pay off their homes and they pay off that mortgage and they finally burn that piece of paper, one of the things that, you know, I often encourage clients to do is, as much as you love the idea of not having anything registered against your home, it actually opens up the door to the possibility of fraud, title fraud, and having your home taken out from under you. Reason being is that there are people out there that are looking for mortgage-free homes. And if you have something as simple as a line of credit registered against your home, even with a zero balance on it, it makes it just that much harder for someone to try to take your home from you. So in addition to having a title insurance policy, on your home for yourself. You can also protect yourself by having something as simple as a line of credit registered against your home. Other benefits of having a line of credit as well is that you have instant access to funds anytime. This is really great. A lot of my investor clients, we always have this set up for them because, of course, when they're looking at buying properties, we use that as a tool all the time, right? So they can use that money all the time.
Yeah, that's actually a great question. So we got a question on, is a HELOC and an RBC home line of credit the same thing? And yeah, it would be.
They are.
We had an individual that also sent in questions before the presentation on this topic, because it has been a big topic. There's been some high profile cases in Toronto where people are losing control of their house. And some of the questions were along the lines of how it's happening. And it's simple identity fraud. You get a fake driver's license. You go to the lawyer and you say you're Mario. And you get a lawyer convinced to sign over title, and it's pretty simple from there. It's very horrible in a sense, and there's actually very little options for individuals once that happens. You got to go to a lawyer, the courtroom, but someone else. The way the scam works, as soon as they get title, they list it quickly, they sell it cheaply, put it as cheap as they can to just initiate a quick offer and get the cash as soon as possible. They hit the fastest offer that'll pay them the money, and they leave the country, and now you have a new legal owner of the property. You can, from a court standpoint, go and fight and try to find the individual that defrauded you, but you're now out of the house. So it's very scary. And so the idea of a RBC home line credit, they call it a STEP program at Scotia, and there's different names out there. It's just the bank has a title. So you go to a lawyer, you try to commit this fraud. They go through the registration process, and there's a big red flag saying RBC is not going to let anyone else take possession of the property. It's just like everything in life. The bank comes first, and they just want to make sure they're fully covered, and that becomes the blocker, right? So that's how the title insurance component segues into it.
Yeah, it's a lot harder for someone to try and defraud the title of your home when there is a line of credit registered against it.
Then there's a title insurance, which is another item. Again, never perfect, but it does provide some coverage. Something you can get when you first buy your property to give you some protection.
Yeah, and you can actually buy a title insurance policy at any time. Yeah, and it's only a few $100s. Yeah, they're like $300, something like that. They're not very expensive.
Could be worth it. And there's unfortunately a lot of fraud that happens in Canada, and it's a private asset. As soon as an asset is private, it's easy to get defrauded. The moment an asset is registered, whether it's a registered investment plan or a registered property with a bank for title purposes, there's just bureaucracy that will hold out the process of you getting defrauded, which in a sense, we hate bureaucracy, but there's times it does help out.
Yeah.
Cool.
Yeah. The other nice benefit of lines of credit on your home is that really once you set it up, you really don't pay anything to have it other than if you're carrying a balance on it. So it really just sits there. It's really just good money to have access to for a rainy day.
Yeah, it can. Yeah, you can literally have a small home. So sorry, I apologize. The question is, if you have the balance of a HELOC is zero, and is it just a HELOC for $100,000 and the property is worth $1 million? It covers 100% of the property.
Yes.
The main thing is really the bank is not going to take away their lien unless they have you, the owner of the property, go to RBC and eliminate that mortgage. And the bank will be very eager to talk to you to find out if they can get assets from the sale of the property for their investment division, or at the same time, are you getting a new property? Can they get you a new mortgage? So the bank will actually throw up roadblocks, even if you want to get rid of the HELOC, to try to convince you to keep it. And also it's like anything else. You get a mortgage. If you don't have a HELOC, you're title free. There is an appraisal. It's a typical process like you're getting a mortgage. But if you owe zero, it's just something that's there that costs nothing. And there is actually a component for retirement planning that does come in handy down the road with it.
And then tax deductible options. So depending on what your goals are financially and how you set things up with your accountant, HELOCs can be used for tax deductible purposes. So I don't get into all of the nitty gritty of it, but I do often work with clients and their accountants, and I set up HELOCs for them and set up multiple components of the HELOC for them based on the advice that their accountant gives them. So that is something that can be really handy as well. So, and used as an investment tool.
Perfect.
And And I think that is
Awesome.
about it.
Awesome. So the other thing I wanted to touch on was just on the retirement side. And we'll eventually have a presentation out in the coming months. Basically, do you want to retire in a home or in your home? And part of that component is having a HELOC on your house. It's very common, like I mentioned, for Canadians to retire with a mortgage. And at the same time, we have individuals where we're providing them regular income from their investments. And we can basically map out the hypothetical date that the funds will be depleted. There are ways of using that asset. And if you have a HELOC, it's money you can pull out at any time. One of the biggest challenges for some individuals is you're later down the road in life, you've depleted your investments. All you have is minimal pension income. You have very little earned income. And as Penny talked about the idea of getting a mortgage, a big factor is your earned income to qualify. So in many cases, when we have individuals that are nearing retirement, they're at their prime earning period. And let's say they don't have a large HELOC or they don't have much of a lien there available, like they might have already a line of credit. It can be worthwhile just going down with a broker or a bank and sitting down and saying, well, in theory, I earn X. What's the maximum HELOC I can have? Because whether I have 100,000 or $500,000 or $1 million, I don't pay anything different for it. I still pay zero. And then down the road, there's no real expiry date. 20 years down the road, I've depleted my investment portfolio, but I want to stay in my home. I can actually pull some assets out without actually going to the bank for approval. I can just start withdrawing and taking some funds out. And there's some strategies you can loop in on how to make the interest payments so you continue to stay in the house. And then at death, the house is sold, pays off the debt, and the difference goes to your estate. We also had a couple more questions. Again, we had a few people that sent questions in advance. There's one that sent some detailed ones, which I did like. Yeah, it was a comment on the retiring the home. So I was hoping I touched on that. It pretty much was the idea that there are some situations where it is not feasible to use leverage in retirement, depending on your situation. I've had people who look at the idea of downsizing, but they might not be better off depending on the type of property. 10-year stat, I can probably dig that up. We're going to post this video on our website, give it a week or so. And I'll make a promise that I'll try to find some data on there and I can insert a slide that'll pop up here to look at it. From a Canadian perspective, I do know that it has worked out very well over the last 10 years if you're comparing Canadian real estate to the S&P 500, which is the US stock market. Yet the S&P 500 has actually delivered a tremendous amount of return over the last 10 years at the same time. What else was there? Oh, so going back to the question, one question which was interesting was the selling a property for $1 to a family or friend. Very big risks here. I'll just kind of highlight a couple. One is I live in my home. I am age 85. My intention is to pass it on to my children. I want to avoid probate. So let me just give it to my child now for $1. That way I'm, gifting early. CRA is going to look at what is a reasonable sale of the property. They're going to consider that an unreasonable sale, first of all. But secondly, they might actually send you a thank you note. If CRA decides to honor that $1 and you have a child that has their own home and they are now the legal owner of your home, it is a secondary property and they'll look at the difference between $1 and the actual real value of the house as a capital gain when they decide to sell it. So there is a lot of risks in changing ownership while you're still alive with the intention of living in the property. So there is some issues there. They might look at the situation of you receiving the $20,000 of income in this question, basically as an unreasonable sale, and they might just look at that as pure earned income, whereas the sale of the property is a tax-free option. We've also seen individuals who are going back to the home line of credit, and what Neil was saying about equalizing an estate where you have one child that wants to own the property and the other child has no interest in it. And let's say for simple math, the home is $1 million. You could, again, you need some work on the tax side and planning side, but just to keep it simple, take out $500,000 of the line of credit at death or when you're near death, give it to child A, child B inherits the property and has to have a $500,000 mortgage to offset it. Keep in mind, again, there's differences in probate for the estate to deal with. There's also a situation of costs, affiliated legal costs, things of sorts. So you could make a perfect example of $500,000 each and then still have one child incurring higher costs than the other. So you do need to have a will review, sit down either with yourself or a lawyer and talk about kind of what does that trickle down effect happen and what is the end impact to it. So you don't have a situation where you punish one child over the other unintentionally. Absolutely debt free. Yeah, so the idea of renting versus buying a home, again, you have individuals. I had an individual once. I had a very small mortgage. They didn't have much income going into retirement. They felt they had to sell their home and rent. And we talked about the idea of just right before they retire, go to a mortgage broker, get a new mortgage and re-amortize for 30 years. Drop that payment very small. And in their scenario, the mortgage payment was $400. And if you add property taxes and utilities, it was cheaper than renting, and they got to keep their home. And it was an asset for their estate as an asset to retain down the road, right? So again, everyone's situation is very unique, but there is many ways of retaining the property using the right individual to help out on the mortgage side to kind of structure the deal that kind of fits the plan. We covered on title insurance in terms of how it works. It does work. Again, there's actually there was one comment before we went live about title insurance where it doesn't work. Did you want to touch on that? And we were chatting about like kind of fraud, piping, the knobs, tubes.
Oh, yes.
Yeah.
So, yeah, just talking about title insurance. So I actually had referenced how if title insurance won't cover something, and it wasn't specific to title insurance, it was actually something that was a little more specific to, I had referenced fire insurance actually. So for example, if someone had knob and tube wiring in their house and didn't disclose it to their fire insurance company and then had a fire in their home, but they knowingly had the knob and tube, the fire insurance company may not cover the home if it was to burn down. And so it's something where, you know, if there's failure to disclose something, you know, sometimes things won't be covered, right? And so title insurance is going to be something similar as well. So if something happens to the title of your home and it's found that there was a way that you could have prevented that from happening knowingly, they're obviously not going to cover it, right? So I think, you know, at the end of the day, title insurance is there to help protect your home against things that unknowingly happen to you. Is it perfect? No, absolutely not, but nothing is. But I think that it's something that is certainly helpful. There's lots of different ways that various different frauds are happening these days. One of the other types of frauds that we actually talked about just before we came on camera today as well was the latest one that we've seen, which is with people buying homes. And so they buy a home and it's time to come up with the down payment, and people are getting emails from who they think is their lawyer and or their lawyer's office, and they're getting an email and it's saying, okay, it's time to bring your down payment in, it's time to, you know, wire the money to us to our trust account, and, you know, send XYZ dollars to our trust account. Well, here's the thing is that your lawyer will never ask you to wire money to them ever. They're always going to ask you to get a check, and it's payable in trust to that lawyer's trust account. And you're going to bring that check in person. So what's been happening is people have been wiring money to what they think is their lawyer's trust account, and it's actually just some fraudster. So that's been the latest fraud that I've been hearing about of how people are getting duped out of their money, out of their down payment money. And in some cases, it's hundreds of thousands of dollars, because some people put very large down payments on their homes. It's not uncommon to see. So that's been the latest one that we're seeing. And so the only thing that I can caution people against is first, know who you're working with. So know your broker and or who you're financing your home with. Know your lawyer. Know, you know, and know your team, right? Know who your team is. Know your fire insurance company and work with people that you trust. Know your realtor and know these people. Work with people that you know and trust and have been referred to. Referral is something that's really important as well. My business thrives on referral. I work almost exclusively on referral, and that's how my business has grown. And so I think that, you know, working with someone that you know and trust or have been referred to via someone that you know and trust is really, really important. And do your background work on these people, so that you know who it is that you're working with, and definitely don't just randomly wire money to someone that you got an email from.
Yeah, it's as the
Scary one.
as the individual on the screen has, you know, the safest bet is pick up the phone and call the phone number that you personally know, that you have your contact to verify if it's real. And it's extremely terrifying, to be honest, on how quickly data is getting out to individuals of your activity. Personal example, I just had my kids' passports, they had expired. I went and got the passports taken care of. And they said they were gonna mail them to myself via Canada Post. And within 2 weeks, I started getting spam text messages saying my package was unable to be delivered. Click this link for Canada Post and put your credit card in there for $3 to get your document. And it's a scam, but it's pretty terrifying how quickly they can connect to what your current activity is via a lot of data points that you now have. To figure out that maybe you might be susceptible to that scam. Unfortunately, you have a lot of lower end bank individuals that will be working from home, and they have family members or individuals in their household that they think they're trustworthy and they're not, that can maybe access their computer while they go on their lunch break or they're not paying attention and go through a lot of data mining. So it is unfortunate how quickly our data is being accessed nowadays, I find, in all industries. And so when in doubt, just call. I find talking to another human being that you know will get you a quick answer that, yeah, it's a request from the right person, or they have no idea what it is, right? But yeah, I really appreciate everyone tuning in. Hopefully at the end of this video, I'll put the contact details for Penny. For those who will see it, we'll have it, like I said, an article on our website, hopefully within a week or so with the video in there. And you can always reach us at Steele Group for any questions, Mark, Cliff, myself, or Neil. Glad to help out. Thank you so much for attending and all the questions. You guys are amazing. Have a great day. Take care.
Thank you.
Bye, folks.